Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Oklo.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis.
Okay, so we're talking about a company that is, it's right at the intersection of some huge themes. We're talking technology, government policy, massive infrastructure.
And that's Oklo, the advanced nuclear developer. It's a story of incredible ambition.
It really is, but I think we have to start with the tension here, the financial reality on the ground.
Exactly, you have to. We're looking at a pure-play tech company that is squarely in the pre-revenue stage.
Which means the numbers, they can look pretty alarming at first glance.
They can. For the third quarter of 2025, the operating loss was, what, $36.3 million?
Right, and that adds up. The trailing 12-month net loss is somewhere around $76.5 million.
Yeah. So when you see those numbers, the first question is always, is this a company that's failing?
Or is this just the sound of a company spending what it has to spend to, try to build a whole new industry?
Well, the market definitely had its opinion on the last earnings report. The reaction was not good.
It wasn't. The quarterly loss per share came in at negative 20 cents.
And the forecast was for negative 13 cents, so a pretty significant miss.
A huge miss. And just that one data point caused the stock to drop. What was it?
6.5%, a sharp drop right after the announcement. It just shows how sensitive investors are to execution in this kind of high-stakes game.
Well, that sensitivity makes a lot of sense when you look at the valuation. This isn't some value stock.
Oh, not at all. It's trading at a really elevated premium, something like 11 times its book value.
So let's break that down. The market is valuing the idea of Oklo, the future potential, at 11 times more than all the cash and physical assets the company actually has on its books right now.
Exactly. It's a massive growth premium. It means that the market is already pricing in near-perfect execution down the line.
Which is, that's the core of the bear case right there.
It is. That premium leaves almost no room for error. And we're talking about building multi-billion-dollar infrastructure projects. There are always errors.
And you need massive amounts of capital for that. We just saw the biggest signal of that risk, didn't we? The shelf registration filing.
We did. A shelf registration that allows them to potentially offer up to $3.5 billion in securities.
$3.5 billion. That's just a staggering amount of potential capital.
It is. And on one hand, look, you need that flexibility. You can't build 14 gigawatts of power without billions of dollars.
But for the people holding the stock today,
for them, that flexibility translates directly into significant future dilution risk. Everyone knows that even with their current cash pile, today's investors are going to be footing a huge part of that final deployment bill.
And you can't help but notice some of the executives have been selling shares.
Right, capitalizing on some of the earlier highs in the stock price. The CEO sold, 300,000 shares?
And the CFO sold over 92,000. It's not insignificant.
No, it's a classic mixed signal for the market. Millions of dollars in sales. That gets your attention. But to be fair, you have to remember the context.
Okay.
Even after those sales, insiders still hold a very substantial stake, about 18.9%.
So they still have a lot of skin in the game. It suggests they have confidence in the long-term vision, even if they're taking a little risk off the table now.
That's the way I see it. So you have this clear challenge, huge capital needs, high execution risk, and a very demanding valuation.
Which brings us to the other side of the coin, the core investment thesis. Why is the market giving this company such a massive premium to begin with?
It really boils down to two things for me: the technology's heritage and a really innovative business model.
Okay, let's start with the tech, the Aurora microreactor.
Right. The whole investment hinges on commercializing the Aurora. And what people often miss is that this isn't some science fiction design they cooked up in a lab.
It's not from scratch.
Not at all. The reactor is based on foundational technology, a liquid metal sodium-cooled fast reactor. It has a heritage that goes all the way back to the experimental breeder reactor 2, the EBR-2.
Which ran successfully for decades out in Idaho.
For 3 decades, yeah. So they're basically taking proven historical tech and, miniaturizing and modernizing it.
But the real kicker seems to be the business model. They aren't just selling the plans for the reactor.
Absolutely not. This is the build, own, operate strategy. It's a total shift. A traditional nuclear company sells a license and a design to a utility.
And that's a one-time transaction.
A one-time deal. Oklo wants to build the plants themselves, own them, and then sell the power directly through long-term contracts, power purchase agreements.
Wait, hold on. Build, own, operate sounds massively
Yeah.
capital intensive. Doesn't that just circle back to the dilution risk we were just talking about?
It's brutally capital intensive upfront, no question. That's why that $3.5 billion shelf filing exists.
Okay.
But the payoff, if they can pull it off, is immense. You're talking about highly predictable, recurring revenue streams that could last for 60 years or more.
60 years. When you think about a normal tech company's revenue cycle, that's just a different universe.
It is. So the business model is structurally superior for long-term margins if you can get the financing to build it.
And to make that model work, the supply chain has to be rock solid. It's not just the reactor. It's all the other huge parts that connect it to the grid.
Which is why that binding contract they just signed with Siemens Energy is so important.
What are they buying?
The entire power conversion system. The SST-600 steam turbine and the SGen 100A generator. Basically the whole engine for their first Aurora powerhouse.
So this is about de-risking the schedule, right?
Mm-hmm.
They're not trying to invent a brand new custom generator.
Precisely. They're using proven, off-the-shelf, commercially available systems from a global leader. It moves a critical piece of the puzzle from the drawing board into procurement.
Shortens timelines, avoids costs. It's a huge signal they're serious about speed.
Exactly. And they're not just stopping at generating power. That move to acquire Atomic Alchemy, that feels like a brilliant strategic hedge.
The vertical integration play.
It's their insurance policy and a margin booster. They bought them in early 2025 to create this adjacent high-margin revenue stream.
Making radioisotopes.
Right, for things like healthcare and defense. These are products that are chronically undersupplied in the United States.
And the timeline for that part of the business is much faster than the reactor timeline, isn't it?
Much faster. The pilot facility for Atomic Alchemy could be operational by mid-2026.
Yeah.
This means they could have lab-scale production and actual sales.
Before the first Aurora powerhouse even sends a single watt to the grid.
Correct. That's revenue diversification coming online much, much earlier than their core business.
That really changes the story. It's not just a speculative power company anymore.
No.
But the biggest risk in nuclear, the classic project killer, is always regulation. The delays, the red tape.
It's a glacial pace, yeah.
So what has fundamentally changed to make anyone think this time will be faster?
A massive policy pivot, really, led by the Department of Energy's Reactor Pilot Program, the RPP. Oklo got selected for 3 projects under this program, and it's a complete regulatory game changer.
How does the RPP get around that old bureaucratic bottleneck?
Okay, so historically, the NRC, the Nuclear Regulatory Commission, required you to have your full license, the COA, completely approved before you could move a single shovel of dirt.
You had to finish all the paperwork first, which could take years, a decade even.
And that's the hurdle that just kills projects through delay and cost overruns. But the RPP provides a different path, a DOE authorization pathway.
What does that mean in practice?
It means they can actually start construction and initial operations under DOE oversight at places like the Idaho National Lab.
Yeah. While the formal NRC license application is still being processed.
Exactly. It completely changes the cadence from sequential to simultaneous.
And we are actually seeing this in action.
Yeah.
They've already broken ground on the powerhouse in INL. The shift from paper to dirt is happening.
It is. And it's not just construction starting faster. The NRC itself seems to be moving quicker. They accepted a key design report in just 15 days.
15 days?
Yeah, that's less than half the time you'd normally expect. It signals real regulatory momentum. Their target for operations at that first plant is aggressive. Late 2027 or early 2028.
Incredible speed, really, supported by federal policy. Okay, so that brings us to the final piece of this puzzle. The fuel.
Right.
You could build a reactor fast, but you still need the special fuel to run it, the HALEU. Why is that such a big deal, and how are they solving that problem?
HALEU, high-assay, low-enriched uranium. It's basically a slightly more enriched fuel that these advanced reactors need. The problem is it hasn't been produced at scale in the U.S. for decades.
So there's a huge supply bottleneck that could sink the whole industry.
It could, but Oklo has a dual strategy to get around it.
Let's do the long-term solution first.
Long-term, it's about self-sufficiency through recycling. They've announced this massive $1.68 billion advanced fuel center in Tennessee.
The country's first privately funded fuel recycling facility.
That's the plan. The The goal is to take used fuel from existing reactors, like from the Tennessee Valley Authority, and turn it into brand new metal fuel for their reactors.
So they're turning nuclear waste into a resource and locking in a domestic supply chain for the 2030s and beyond.
Exactly. It's a visionary long-term plan.
But that's the long term. What about now? What about the fuel for the first 10 or 20 plants they want to build before 2030?
This is where that unprecedented government help comes back in. They call it the plutonium bridge strategy.
Plutonium. Okay, that sounds complicated.
It is, but it's also a massive shortcut. The government has up to 20 tons of surplus plutonium available, and Oklo is exploring how to use it as a bridge fuel.
Why is that the faster option? It sounds incredibly complex to handle.
It's faster because of the physics. If you take that 20 tons of plutonium and blend it with unenriched uranium, you can create roughly 180 metric tons of Aurora fuel.
And that's enough to run.
The first 10 to 20 plants. And here's the crucial part. Using this government material negates the immediate need for enrichment. It bypasses the current HALEU supply bottleneck in the U.S. entirely.
Wow. So the government is basically taking a legacy liability, this plutonium surplus, and turning it into a massive accelerator for the entire advanced reactor industry.
That's it, exactly. It fundamentally changes the risk profile. This isn't a theoretical regulatory and fuel problem anymore. It's now a concrete execution and timeline problem.
And this acceleration is happening just as the demand signal is becoming a roar. I mean, let's talk about their customer pipeline. It's just astonishing.
The market is desperate for this kind of power. They have a non-binding pipeline of over 14 gigawatts.
14 gigawatts. And who is that demand coming from?
Overwhelmingly from the fastest growing part of the economy. Hyperscalers and data center operators. The big tech companies that need clean, reliable, baseload power for their AI infrastructure.
I mean, that's an existential need for them. Renewables alone can't consistently provide the kind of 2047 power that AI data centers require.
They can't. The market is just sitting there waiting for a solution like this.
And despite all the cash burn we talked about at the beginning, Oklo is sitting on a fortress of a balance sheet to go after this opportunity.
They are. They finished the third quarter of 2025 with $1.2 billion in cash and marketable securities.
So if they keep burning cash at their guided 2025 rate, which is about 65 to 80 million a year.
That gives them a runway of maybe 14 to 18 years at their current burn rate.
A very long runway.
It's the key to their whole strategy.
Yeah.
That cash buffer buys them the time they need to get through the regulatory process and hit that 2027 or 2028 operational target without having to do panicked emergency capital raises.
So that high valuation, the 11 times book value, it's the market basically pricing in the massive scale of that 14 gigawatt opportunity and assuming this government acceleration strategy works.
I think that's right. The bear case is all about the financial metrics of a pre-revenue company. It's real, but it's expected.
But the bull case rests on this unprecedented external help. The regulatory fast-tracking, the plutonium bridge fuel, it all shifts the risk profile.
It moves it away from can they get permission to can they physically build it on time. The company's success is now purely about execution speed.
The speed is the story. The government has cleared the runway for them to build faster than we've seen in this industry for decades.
It really has. I think the next big test, the next inflection point, will be watching how quickly that 14 gigawatt pipeline of interest starts turning into firm, signed, capital-backed power purchase agreements.
Sometime in 2026, you'd think.
Yeah, that's when the cash flow story, the real story, finally begins.
A truly fascinating setup. If you found our talk useful, please remember to subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.